US jobs growth was much stronger than expected in March, but wage growth didn't rise as much. Markets, though, are still 100% priced in for a Fed rate cut in July. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ Pacific economist Kishti explains why tourist hotspot Fiji needs to build 4,500 new hotel rooms over the next decade.
If Fiji had additional capacity, it would have crossed 1 million arrivals last year.
But first, in 5 and 5 with ANZ. US non-farm payrolls data dominated in trading on Friday night and over the weekend. Jobs growth of 303,000 in March was well above consensus of about 200,000. But wage growth wasn't quite as strong as that number would suggest. The prospects for a cut in June are fading, but July is still very much in play. Here's ANZ Group Chief Economist Richard Yetzinger.
We've been a bit later than others in looking for the Fed to start its tightening cycle in July, but we're getting to the point where the strength we saw in payrolls, and we've obviously got inflation coming up this week, the strength we saw in payrolls is starting to become a bit unhelpful. Leading into that number, the market in the US was only pricing the first full hike by July. I mean, some chance of a move before that, but the first full hike by July, and obviously it's taken some prospect of that out.
Number 2. One factor softening the effect on markets of those stronger jobs figures is a new research note showing much of it may be coming from migration and therefore might not be so inflationary. Here's ANZ Head of G3 Economics, Brian Martin.
There's interesting research out recently from the Brookings Institute suggesting that owing to strong net migration in the US, could now be the case that you can have payrolls growth as strong as 160 to 230,000 on a monthly basis without adding to upward pressure on wages or inflation. And that's a message that Chair Powell has conveyed recently. He has said that strong labour market growth is not necessarily going to be an obstacle to rate cuts.
Number 3. Richard says US inflation data for March, which is due on Wednesday night this week, will be crucial for those betting on whether the Fed can start cutting in July.
This is a big number, I think, this week in terms of US inflation. There needs to be enough signs there that disinflation is coming through for the market to keep July alive.
Number 4. The other big news this week will be the European Central Bank rates decision on Thursday night. It's seen as closer to cutting than the Fed. Here's Brian again.
What they really want is just more certainty that this improvement in inflation is lasting and it's going to be durable. And at the moment, some of them think it could be a bit fragile because wages are high. So they'll just want to see additional confirmation that wage growth is moderating.
And so how certain is that June rate cut now?
It's fully priced by the markets. The market is 97.5% priced for a 25 basis point rate cut that month. So you really can't get much more than that. I think the shock would be is if the service price inflation numbers prove quite sticky and therefore inflation is higher than what the ECB is projecting for the second quarter. The ECB projects that inflation should fall to 2.5% in Q2. If it doesn't, well then, based on the criteria that the ECB set out for rate cuts, it might be the case that they would delay it into the third quarter.
Number 5. There are signs that the RBA's monetary policy settings are effective. ANZ economist Maddie Dunk says last week's household spending indicator painted a clear picture that rate hikes are working.
It's a really challenging environment for a lot of households right now, and their budgets are being squeezed, and that's flowed through to spending. We're seeing that discretionary spending is down 0.2% over the year, whereas essential spending is up almost 7%. So people are still having to pay for the groceries, for the medicines, the petrol, but they're cutting back on those optional items.
Maddie Dunk there. Now, in today's bonus deep dive interview, ANZ Pacific economist Kishti says Fiji's hotels are filling up during its peak season after a successful reopening post-pandemic. But thousands more rooms are needed over the next decade.
So Fiji basically was once again allowing free movement of people from the 1st of December 2021, and that saw an influx of first-time leisure travelers to the country in 2022. Last year, you had the traditional tourists returning to Fiji, and then you had some of the first-time visitors from 2022 also coming back for their Fiji fix. So the net result was a record number of visitors to Fiji last year. Fiji received 929,740 visitors in 2023, which was up 4% on the previous high achieved in 2019. Now, I have no doubt that if Fiji had additional capacity, it would have crossed 1 million arrivals last year. So peak season months, which typically go from June to October, and then in December, the tourism hotspots such as the Denarau Island, the corridor along the Coral Coast, the luxury hotels in the offshore islands were regularly hitting occupancy rates in the 90s. Now, that's never been done before.
You've got some forecasts there for the number of rooms that are going to be completed by 2028. But is that likely to be enough if there's going to be continued growth in visitors?
We believe Fiji needs about 7,300 additional rooms to be able to service 1.2 million visitors during peak season months in 2033. So projecting out 10 years, we think Fiji can accommodate about 1.2 million visitors during its peak season months. Fiji is also bringing in new room inventory by building new hotels and resorts. By our count, we think there's another 2,000 odd rooms over the next 4 years that is expected to come online. But that won't be enough. If Fiji wants to aim for 1.2 million visitors during its high seasons by 2033, it's 10 years out, then we believe it will need to build another 4,500 rooms over the next 10 years.
Is there the capacity in the infrastructure, the building materials, the labour, the staff to be able to handle all those extra rooms?
Yes, no doubt Fiji will have to invest in infrastructure as well to be able to accommodate what we are forecasting could be a doubling of peak season arrivals 10 years out. But we are not suggesting that Fiji build the monster hotels, which accommodates about 3,000 to 4,000 people at a time. All we're talking about is bringing on more boutique 100 to 200 room style accommodation over the next 10 years.
And are there the investors and the brands to do those boutique hotels?
Yes, definitely investors are interested. So we've got a new Regis managed hotel going to be built from June of this year. The Crown Plaza is also a new international brand that will be operating from May this year. And Fiji pretty much has all the other renowned hotel chains operating in the country already. So they will be looking to expand as well in order to service some of the anticipated growth in demand that we are forecasting.
Kishti Sen there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, April the 8th. Catch you tomorrow with more detail on what central banks will be deciding this week. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.